he needs no introduction. Abe Cable is our speaker today. You might be most familiar with Abe's work as our Zoom czar lately, but even as he is troubleshooting tech issues and gently guiding us across the virtual Rubicon, he has managed to maintain an ambitious research agenda. And so that's why he's here today to present his most recent work. So he recently published an article in the Journal of Corporation Law that reveals how Silicon Valley lawyers understand high-profile judicial decisions' impact on how they advise boards and negotiate financial transactions. He has been instrumental in developing the footprint of our Center for Business Law, interviewing scholars and practitioners for podcasts that we broadcast to the Bay Area business law community. And today he's presenting his paper, Time Enough for Counting, on the outcomes achieved by early unicorn startups. So Abe, you know the drill. Go for it, and I'll keep the cue afterwards.
Okay, great. I will pull up my slides. Okay, so first off, sorry for the Kenny Rogers gimmick. It's beneath you, but just trying it on for size. The paper is about unicorn startups, and to the extent that has a technical meaning, it means that you've got a private company, in other words, a company that hasn't exited through an initial public offering or through sale to an established company like Apple. So a valuation as a private company of at least $1 billion. More specifically, it's usually demarcated by a post-money valuation. So the idea there is that an investor in a startup would start with a pre-money valuation, valuing the company by some chosen measure or technique. It could be comparable companies or valuing future projected cash flows. Then to that, the investor's investment amount is added. And then that number is the post-money valuation, sort of a company-wide valuation. And what it's normally used for is then to divide that number by the company's projected share count, which results in a price that the venture capital fund is willing to pay for a new share of preferred stock. So that's where this jargon comes from. And it's really this bottom line company-wide post-money valuation that gains a company entrance into this unicorn category. So I've got here a screenshot from one of the many, many unicorn lists, the Wall Street Journal's $1 Billion Startup Club. It's the one I tend to focus on because I think it's probably the best one that's backed by a sort of high-end commercial data provider. So here, let me sort of walk through my little pointer. So on this infographic, I had it set to 2014 when people first started talking about unicorn companies as a thing. This chart, each little ray from the 45 companies circle suggests a company that has reported a post-money valuation of $1 billion. That dotted line is $1 billion. And some had by that point reported higher valuations all the way to 10 billion. That was considered at the time a decacorn, something even more spectacular than a unicorn. If we fast forward then to late 2019, when the Wall Street Journal quit updating this, you see we have many, many, many companies that are announcing these post-money private valuations of usually exactly at $1 billion. Some considerably higher. So these rays are representing companies like Uber and Airbnb that have valuations in the tens of billions of dollars. So that's unicorns, and there is no question that there's a big difference out here in how large some startups have become. I think you can understand this in part as being a function of economic circumstances, low interest rates, investors chasing yield in alternative investment classes and things like that. But it's also in part, I think, a regulatory development. And so the history there is, I think, really starts in the late 90s with corporate scandals at companies like Enron, which were followed by the Sarbanes-Oxley Act, which was a very significant tightening of public company regulation in order to restore confidence in public stock markets. Google and Facebook grew up in the shadow of Sarbanes-Oxley and that strengthened regulatory environment. The perception is that in part because of such demanding public company regulation, they put off being public companies for as long as they could. In fact, until they ran up against provisions of securities law that say once you've accumulated enough shareholders through investment and through employee stock options and the like, you are required to become a public company. Google and Facebook ran up against those limitations. Congress responded fairly explicitly in response to Google and Facebook by increasing that share threshold so that companies can stay private longer than Google and Facebook did, and that was a pretty explicit tie to the Google and Facebook experience. So this isn't like some shock that came out of nowhere to the regulatory system. It is a foreseeable development, and I think it reflects an assumption that the primary participants in startups in the entrepreneurial economy, that employees and founders and investors can, through private ordering, essentially fend for themselves, and that we don't need the public company regulation and what it adds until this later stage in life. So I think that's kind of where we are. And just to put a point on it, if you look at the dot-com era startups, Yahoo being one of the sort of more storied ones, it went public with 50 employees and a company value of about $400 million. If you just multiplied its outstanding shares at the time of its IPO times its IPO price. Uber had 22,000 employees and a $76 billion market cap by the time it went public. So this is really is at some level for these sort of higher end unicorn companies. You know, there's no doubt that there's something sort of going on in the market. There are also some signs, yellow flags that should be paid attention to and are at some level concerning. So within the group of companies I'm looking at, you have Theranos, which is just a sort of abject fraud. We have companies that have had internal governance disputes like Uber and WeWork, sort of fights over who should run them. We've had markdowns in private company valuations that have gotten a lot of attention. So there's lots that legal scholars have worked about. Where I'm coming at in this project is simply we need to start the project of figuring out whether these are isolated incidents or whether this is some sort of pattern that we should be concerned about that would have us second guess that assumption that private ordering is sufficient for these startup companies. So what I've tried to do is to try to take a sort of manageable set of companies, one of the earlier unicorn lists from 2014, and to just track the outcomes. It's a very exploratory type of analysis. I think its main contribution is the categorization scheme. And it's, I think, obviously not enough information to reach conclusions about this category of companies if we want to think about it that way. So this is, I see sort of as a first step in a longer project, but it's a step that we can start taking because out of those 32 companies identified as unicorns in 2014, 25 of them, soon to be 26 when Airbnb has its IPO, have exited. They've either had an initial public offering of stock, which is the end point of private company status, or they've sold to larger companies. It is a bit of a hodgepodge of companies. There are companies founded in the late 90s that have just reinvented themselves over decades and finally attracted large amounts of financing. You've also got newer companies, that were founded in 2012, like Snap. You have a wide variety of industries. So, SpaceX is in this group of companies. So is a company named Fanatics that makes, team logo baseball hats. And so, so it's a fair question whether ultimately this is sort of the right grouping for tracking outcomes of large startups. But I think it's sort of a viable starting point in terms of, we have a critical mass of companies that have sort of ended private company status, and we can look at how that went. So I tried to divide the companies up into 5 categories, and the largest category is sort of the most successful company I call them ascending IPOs. And the idea is that the last price that investors paid in a private financing was lower than the IPO price, the price that the company offered its shares to the public. And that's the trajectory that we'd expect. An IPO is considered to be sort of the gold standard end of a startup. It's not normally within a broad range of startups the most frequent end of a startup, but it's sort of the trajectory that's hoped for, that animates the whole system. And this is the largest of the 25 exited companies. 8 of them ended this way. I try to dig in a little to just give some feel for what these companies are like by looking at one that's was not really in the headlines, Pure Storage. Just to give you some sense. And so at the IPO price, the shares held by the founders that they most likely paid nothing for, they'd usually pay with their sort of rights to developing intellectual property, was worth $230 million. It's not that they got a check for that amount, that they can't just liquidate all their shares at once in the IPO, but their stake in the company was worth that at the IPO price. Employees who had been granted stock options, so it's normally a right to purchase stock for an exercise price equal to the fair market value of the stock on the hire date. So so every option has its own exercise price keyed to hire date. That equity compensation at the IPO price had a value of about $750 million. The first venture capital financing, called the Series A financing, involved venture capital funds paying $5 million for stock that ended up being worth $400 million. The last round of financing as a private company that came in the same year as the IPO had a much more modest gain. Stock that cost $225 million was worth $243 at the IPO price. And so this is what you see, and part of the reason to include this is to make the point, timing is kind of everything here. The people who get in early have these really outsized returns. Later stage investors pay higher prices. Their money isn't tied up as long. They don't presumably take on as much risk because the company's crossed a lot of important milestones. They won't profit as much even in a successful company. That's all fairly, I would say, in a way, typical of the venture capital Silicon Valley model that we've sort of come to expect over decades and decades. There are some sort of trends that are very of the moment in this group of companies. There's lots and lots of dual class voting structures where founders at the time of the IPO are going to hold shares that have many more votes per shares than what the public shareholders will hold. In other words, founders will generally retain a high level of voting control all the way through the IPO. These companies feature, for the most part, the founders still serving as CEO, which is actually not the norm across time and across most startups. It's been somewhat rare, and only sort of the rock star CEOs, the Mark Zuckerbergs, who managed to keep control through the IPO. Usually a sort of professional manager is brought in at some point. We also see something legal scholars have talked a lot about, which is non-traditional investors in late stages, things like government entities. So there's an investment vehicle set up by the CIA that invested in a couple of these companies. We have sovereign wealth funds. We have corporate investors like Samsung and Foxconn and Google. We have mutual funds, T. Rowe Price and Fidelity, who are buying these late stage private company stocks. And so we see all that, and that's all sort of well recognized trends that are here as well. You know, the next set of companies are ones that this is sort of a phenomenon that gets a lot of attention in the press, I would say, where the press will describe an IPO as being sort of disappointing, in the sense that for this set of companies, the price that investors paid in the last private financing was higher than the IPO price. So in the sort of jargon of Silicon Valley, the IPO price was actually a down round of financing. And so this does represent the possibility that some of the investors, the later investors, have losses. It's also possible that some employees who receive stock options keyed to these higher valuations might hold stock options that don't have a lot of value at these somewhat lower valuations. But I also think one of the more notable things is that we also see in late stage investments, one of the early examples of a contractual response to this problem of, if we want to call it a problem, to pricing challenges in private companies. So the last round of financing for Square, if you look here, so Square, the last round of financing was paid almost $16. The IPO was at $9, which would make you think that those last stage private financing sources overpaid, but they had something called an IPO ratchet, which it's affected through a change in conversion ratios, and that's all a little technical, but the basic point is that they were promised extra shares in the IPO if the IPO price was below $18. In other words, they had sort of a built-in guaranteed positive return if the company got to IPO. So they received additional shares in connection with the IPO, and everybody else's returns had, you know, about 2.5% sort of shaved off to accommodate that extra amount, just the way that the math worked. So this is a response to the challenges and the possibility of this category of descending IPO. The next two categories are examples where the company is sold. So Beats Electronics sold to Apple. Here we don't have the per share information that ends up being the best measure of sort of how things went for late stage investors. So what we have are, we know the amounts from commercial data sources of how much investors put into the company. So in the case of Beats, investors put in about $500 million into the company. Later rounds of financing suggested the company was worth about $1 billion. Down the road, when it sold to Apple, it sold for $3 billion. So everybody's happy with this type of an exit. There are also sales where the good technology, for example, investors put in around $400 million, thought the company was worth $1 billion, and then it ends up selling after a failed attempt at an IPO to BlackBerry for $400 million. That's below expectations. It's also not that much above the total amount of money that went into the company. And after paying off debt and other expenses, we know from litigation documents, because there was litigation, that this came close to wiping out the returns for founders, and probably did wipe out returns for most employees. And then, of course, we have worse examples like Fab, where investors put in $355 million and it only spits out $150 million. The way this tends to work is that the venture capital funds buy preferred stock. They get a liquidation preference in the amount that they invested. And so the first $355 million goes to venture capital funds or preferred stockholders rather than to employees or common shareholders. So we know that there are losses in this set of companies. I'll say the most probably noticeable thing, though, about both the ascending and descending sales category is that they're so small. It's about 5 to 1 more likely that a startup ends through a sale, through a usually a merger with an acquired company, than an IPO. I mean, so the sale category, if we were to look at the overall population of startup companies, would be far larger than the IPO categories. And so we're definitely seeing something a little different here. Good technology is one that we just happen to know a lot about. So it's kind of a nice case study. The bottom line is that option holder, the common stock ended up being worth about 50 cents by the time liquidation preferences were paid out to preferred holders, by the time expenses were paid, by the time debt was paid off. And for most option holders, they had exercise prices keyed to higher valuations of the company's stock, more like $2 or $3. And that meant that the options were worthless because you don't pay $2 of exercise price to get 50 cents worth of stock. So this essentially wiped out the interest of the option holders in this particular case. And some had even paid taxes on their options, on the exercise of their options, at times when they and the IRS were under the impression the stock was worth a lot more. So they actually had some out-of-pocket losses. You also see all sorts of conflicts, which happen when there's not enough money to go around. So preferred shareholders felt different than common shareholders. Even within the sets of common shareholders, some had IPO ratchets, some didn't. They had different purchase prices, different investment expectations. It seemed to be a mess. Not as bad as these companies, though, which ended in sort of total wipeouts. So Fisker Automotive ended up in Chapter 11, presumably wiping out the value of equity. The other three companies, Theranos is in there, resolved the way a lot of startups do when they completely fail, which is through a state insolvency procedure, an assignment for benefit of creditors, where the assets are assigned to a professional liquidator with very minimal or no court supervision, and sold off to pay creditors with.
Abe, you froze on
We
us
have
there
a pretty
for
good
a
sense.
second.
Oh, sorry. Okay. Yeah, I'm getting a sign. Okay, so we know that it didn't go well for these companies. Okay, so as I mentioned, I think the primary goal of the project was to create this categorization scheme to work through what information is available, what isn't. I hope to continue the project of getting up to numbers that would have a little bit more statistical meaning, but I do think it's worth just to test the usefulness of the categorization scheme to sketch out what it would mean if this was the pattern. And look, we see founders in sort of a heyday, maintaining control, reaching IPO. It's sort of widely recognized, I think, in this industry that these are good times for founders. It's also a very good time for the venture capital funds that invest early. They're raising records amount of money, putting record amounts of money to work. It's a little dicier for later stage investors, but I do think we see some adaptation in things like the IPO ratchet, which is maybe what we'd expect from really sophisticated investors. To me, the linchpin is employees, and they are not as well equipped to fend for themselves in this environment of private ordering. I still do, though, see some signs that the very significant reputational market at play in Silicon Valley is doing some work. So these are not your traditional vulnerable employees. These are people with skills that are sought after by a variety of different types of companies. So we see companies changing from stock options to RSUs, restricted stock units, which are outright grants of stock that are that are a little trickier tax-wise, but that take care of this problem of such volatile returns on stock options. There's also a move towards a much more professional and uniform environment. There's sort of like turbo tax for stock options that companies are using called CARTA that provides a lot of educational resources to investors and provides kind of a professional HR function to stock option grants, which previously were done in kind of an ad hoc manner sometimes. So, I want to build that part of the paper out a little bit more. But my intuition here, I've written about these employees and equity compensation before, and my intuition is that this is an area where some maybe modest protections could be in order. But there are papers being written about basically subjecting unicorns to a sort of quasi-public company status regime where there's lots of mandated disclosure, and I get it, but if this is the pattern, I think it's pretty hard to say that there's some big problem at this moment that needs fixing. Okay, so that's all I've got.
Great, thank you so much. So who has questions?
So,
Manoj?
If I can unmute myself, I think I am. Okay, thanks, Dave. I thought this was really interesting. And on your very last point about how you come down on, hey, I don't think we need to have a quasi-public status for these unicorns. And I think the slide right here actually gets to one of the questions I was going to ask, which was, your goal is to identify the key participants in the entrepreneurial economy and see how unicorns might relate to them. And I think this is your short list of these key participants. And I totally agree with you. It's hard to come up with a reason to regulate more based on these groups. I'm not really sympathetic to founders, not sympathetic really to early stage or even later stage, frankly, investors. And generally with the startups these days, the employees are also, I'm not too worried about. I'm wondering if there is another group that you should include potentially, which are consumers. And I think that there's something potentially about massive valuations of relatively new companies that are largely based on consumer data. And so to the extent that you have a group that is getting potentially used in this scheme, there's at least a chance for some companies, they're extracting value from consumers, and perhaps there is value in additional regulation in the form of, like, just if you had quasi-public status, the additional disclosure with 10Qs and 10Ks might just be one of those sunshine is the best disinfectant for consumers to see potential malfeasance of these companies. And so I just wanted to know if you could hum a few bars on that.
Yeah. Are you asking me to hum The Gambler? I think I should, at the very least, be clear about sort of setting the boundaries of the project, right? So part of it is that I have had a focus on sort of a law and entrepreneurship type perspective that cares primarily about the people up on the screen right now, and so I mean, I would really need to put more thought into the sort of consumer point. I mean, I tend to think that if there are things we're worried about, whether it's like data use or data privacy or other ways that we feel like consumers are being exploited, that needs to be addressed from some other angle, and that I'm not sure, just thinking through it, like what even if you were to engage in sort of full-throated public company disclosure with all the bells and whistles, I'm just not sure that regime or the things that people are talking about is especially useful information for consumers, but I'm willing to be, persuaded.
I'm not sure either. I just, that's why I was curious about it.
Yeah. I mean, I do think that there are, societal effects of having the sort of race for consumer data. And that's the way I look at it, as a sort of privacy and transparency perspective. But I'm not sure that the types of proposals that I'm sort of arguing against are quite on point. But I'll certainly think about it.
Okay, I've got John Crawford next.
You hear me?
Yes.
All right. I like this a lot, Abe. I think it's great. I liked the Kenny Rogers. If you're gonna keep the Kenny Rogers or the horse, I'd keep the Kenny Rogers. It's a nice title. I feel like we've been through this once before, but I'll just throw it out there again. I guess one way to put it is how do you, if the point of this is to kind of consider how the early returns should inform further regulatory moves or not, what is at stake in differentiating sales and IPOs instead of just having ascending exits, descending exits, and insolvencies? I saw, like, first I was a little confused. The IPO ratchet kind of got me thinking that there might be something there, but I still can't quite put my finger on it. Was wondering if you had any thoughts on what you see as a potentially being at stake there.
Yeah, I mean, I do recall the comment, and I considered it. So what basically ended up happening is, as I looked more into the descending IPO category, I was increasingly unconcerned with it. Partly because of the presence of IPO ratchets, partly because it gets sort of worked out often as the share price goes up later, partly because of the fact that investors tend to invest in multiple tranches along the way. So to me, it's a fairly mild set of sort of conflicts and harms, whereas the descending sales are severe. I mean, they're just a train wreck, and there's not enough money to go along, and it's the stuff that Delaware judges are writing about and people are thinking about. So it's the stuff that wipes out most shareholders altogether. Part of it is just, one way to think about it is the liquidation preference just shifts all the consideration back to the preferred shareholders and creates this set of conflicts that's quite different. The other issue is that you can't get the same information for both categories. So it's actually a lot better to be thinking about it on a per share basis rather than these company-wide valuations. But you can only get that per share information reliably for the IPOs.
Thanks, that's great. I also wanted to just mention that being on these Zoom calls with you, I just feel like we're all islands in a stream, and I love it. Thank you.
Oh, John, you got to know when to hold them. All right, that's Robin next.
Thank you. I did like the Kenny Rogers. I thought it was a great analogy for what happens in these things. Can't possibly offer as funny comments as Jody and John, so I'm going to stick to the academics. You may have mentioned this point. I'm afraid I had to step out to interact with a household member, but but if you didn't, there's one other group that you might think about, and those are some of the early round investors, the friends and families, so the smaller folks who get looped into these things. And what happens is that in the later rounds, they can be told that you have to buy more, or your interest will get washed out. And so they're coming in at later rounds, and that may be more of a financial strain. They're coming in at later rounds, and as you pointed out, later rounds can be less advantageous, and later rounds can also be the initial signal that they're, about to go down the tube. So they've got to pour more in money, and then the whole thing, then they're in the bankruptcy. So that's that's a group that I worry about, and then I increasingly think about as, you know, Ma and Pa Kettle try to get in on the tech and the IPO rush.
Yeah.
They might be worth thinking about.
Absolutely. I hadn't thought about particularly, I mean, so if it's just friends and family kind of in early, they have the timing advantage, but if they have these pay to play arrangements, I
Exactly.
really hadn't thought of that. And so
Yeah, so I think initially it
that's
looks
good.
great. It becomes
Right.
less great over time. And the
Right.
definition of friends and family, I think, has gotten a little looser over time, and also,
Sure.
just as as the regulations have changed on, you know, we used to protect this group fairly strongly and want them to have, certain qualifications, and I think that's loosened over time. So they might be worth thinking about. The second is just in response to Manoj's comments about how the value in these companies is sometimes built on information that's coming from consumers themselves. What do consumers do? Or if you think about automatic car companies, you've got lots of information they're getting from how people drive and the choices they make that create a lot of the value. So, but I think the approach, if you're going to look at those, is one of two ways, and one is an intellectual property, and the other is a privacy, for lack of a better word, but privacy is really wrong. I think of it more, the term I use is information integrity. But from an intellectual property standpoint, and I've written about both of these if you want some of these at any point, but
Yeah.
from an intellectual property standpoint, the question is, if you are building on other information, to what extent do you have intellectual property rights on those, and to what extent are those mitigated? The information integrity privacy angle of that says, well, maybe we're not going to either mitigate your intellectual property or give the intellectual property to the consumers that are involved, but maybe instead, at least the consumers should have some type of control. That is, the ability to know what their information is being used for, the ability to withdraw their information, to opt out now or later, the ability to monitor and make sure that it doesn't go in places they want, or that it isn't wrong or distorted. So I think those are the categories, but it's the IP and the information route that I would frame the consumer consumer contribution issue, if you decide to go in those directions.
Yeah, that's great. I mean, I'm sort of putting that together with Manoj's point. I suppose there is this issue of if we were to find that these are just very unstable companies, essentially, and that they tend to fail at high rates, even though they have the appearance of being more stable, there's a kind of consumer harm that comes of that when people have these sort of, consumer interests in their information being tied into these networks and things of that nature. So,
or sometimes we just regulate bigger differently.
Yeah.
More dollars, yeah. It's worth thinking about. Some,
right.
Sometimes.
Right.
Anyway, I'll hand off.
Okay. Great. Thank you.
Okay, great. Thanks. So I'm actually going to take the prerogative to slot Jared in. I think he was at the top of the queue before, and he keeps having to drop out to address childcare issues. So while we've got him, Jared, you've got the floor.
It's actually my parents' flaky internet. It isn't possible here in Michigan to have like Berkeley level internet, which is very frustrating. But anyway, this is really a fantastic project. I think that, while it's, it's based on a modest sample that's a snapshot of a certain period, which makes us worry a little bit that maybe we wouldn't take the right things from it. However, it's big enough and there's been enough time, and your logic for only relying on that period makes total sense. So when I read it, it dawns on me that this, will probably, get some traction in the press. And I wonder if you want to think about whether or not your current categories of ascending IPO and ascending sale are dumb enough for reporters who are, as our current president says, maybe not our best and brightest in some ways. So I'm not sure what an alternative formulation might be, but I think that once you make this thing public, you're going to be stuck with these categories. So I'd urge you to think a little bit about exactly whether or not, like, they are what you want. And then also maybe as a reference point, you could try to calculate whether or not these were ascending or descending, not from the last private market price, but rather from where things stood at, the first, when they first became a unicorn, right? Which I don't think you're doing in your paper unless I read something wrong. But like at some point there was a financing that valued it over $1 billion, right? And then there, firms don't organically then go public at a certain point after those financings. They, some of them will continue to have financing rounds for some period of time. And it'd be interesting to look, use as a comparison point, sort of that unicorn moment. Maybe it is your primary, specification. Maybe it's something in an appendix, but that makes it easier to understand exactly what happens to these companies, because it's less interesting to say, versus, when they became public, when they sold. I think it's more interesting and sort of standardized to use that $1 billion number as a reference point. With that said, again, I think this is great, and I would encourage you to finish it up and throw it on SSRN and, start, marketing it.
Yeah, I think I could do that. I had initially had an idea that I would have I would measure also against like the median financing round. So sort of like the middle tier investor, but the information gets super spotty. But usually the first unicorn round is publicized. And so I do think I could probably identify that, and at least with the IPO companies, I could sort of add a column to the table based on that. So
yeah, and I would almost use that, depending on whether or not you think the results of doing that are deceptive. I might use that as your primary specification, and then do the work of looking for IPO ratchets and other things that might alter outcomes for pre-IPO investors as a sort of backup analysis, to make sure that once you kind of give effect to all this extra institutional detail, that what you're finding originally makes sense, because that's a one sentence paper, which is, compared to, if you were to invest at the unicorn moment, you would have made money in X number of cases versus Y. But when you take a closer look, you find that not all of them made money, not all of them, there are subsequent investors who didn't do as well. And then maybe you have some interesting things to say about like companies that continue to be private unicorns and do financings on top of financings. Maybe you don't, but I think trying to standardize this in some way, even if it doesn't give you the institutionally purist takeaway, so long as you also have that takeaway in there, is the right way to sell a paper like this.
All right, thank you.
Sorry.
Rule is next.
So I have a couple of things, and they're all based on the ignorant reader. And so the first comes off of what Jared said, which is I did find myself wondering about the significance of the IPO share price, and then what then happens in the aftermath of the IPO share price.
Mm-hmm.
If we're worried in some regulatory way about potential investors, and you're kind of it's almost as if you draw a line between investors who were institutional investors, or I'm not using the right language, people who are investing before the IPO, people who invest at the IPO, and then for some period of time after the IPO. And I know, of course, we have whole regulatory regimes for sort of people who are investing in public companies, but I found myself wondering whether there was some period and I don't know what even the time frame would be in the aftermath of the IPO, where we have some heightened sense of protecting investors in some way. That was the sort of first ignorant question, because the answer just might be no. Second was, this, at least with respect to employment law, most of the regulatory nonsense and incompetence occurs at there's a greater regulatory concern earlier in the process. And whether we're worried, in some sense, are we worried at the wrong place? Like what you may be demonstrating is that actually by the time you're reaching this level, the markets are working pretty well. And so I find myself worrying perhaps more about the startup, right, rather than the investment. And maybe that's outside of your scope. And then just the final point, that to the extent that the alternatives that are mentioned, the more regulatory alternatives are disclosure-oriented ones. I would just find myself wondering whether, particularly with this population, whether those make any difference at all, other than just a regulatory burden. Whether, in fact, one of your arguments could be, not only does this show that we're not need to be particularly worried about these people, but the alternative is actually not a particularly efficacious one.
Yeah, I mean, so taking them, I guess, in reverse, I'm just very skeptical that some amount of disclosure helps the people we're worried about, who are employees. I've had a couple different people I've talked to who did hiring at startups make an identical point, which is that when they hire people and grant them stock options, they tell them how many options they're getting, and then the person says great, and they might even negotiate over that number, but they never ask how many shares the company has outstanding, what the denominator is. In other words, they never ask the most basic question you would need to ask to figure out what, even if you knew the company value, like how much you own. So I just really don't think it's a group that's gonna like tear through some like fair housing disclosure type thing and get much out of it. I have to sort of think about when to protect employees. I'll just say I've made the point in a prior article that for some reason the SEC just, in traditional private placement law, the SEC made a big point that just because someone is an employee, they're not able to necessarily fend for themselves and be eligible for private placements, that's not sort of close enough to the company. But then they just sort of reversed course in a bunch of regulatory actions, and the fact that someone is an employee is considered to be some indication that they are like intimately close to the company and know everything going on, and they get like sort of no protection. So it's interesting that way. And then on the sort of what happens afterwards, I do think it might be worthwhile. I'm thinking about adding a column or a table or something that would, so what happens is that lots of the people who hold stock when there's an IPO, most of them are subject to sort of lockup periods where they're not allowed to sell their shares for a period of time. And so it might make sense to just give the like closing share price on the NASDAQ stock market at the end of what is sort of the normal lockup period, to just sort of play it forward. Because the fact of the matter is, I mean, I have ended at the IPO, because after that, who knows? I mean, the stock charts go up and down, and there's, different people who have tried to measure whether these IPOs as a class perform better or worse than IPOs over different periods of time. I mean, it almost just sort of becomes a different paper about young publicly traded companies, which is just requires different information, different skill set, different everything at that point. So, but I could do when do the employees get to sell stock price, which would be
that gives you, I mean, I completely hear what you're saying. And again, this is just my ignorance. It just seems like there's some period that might be meaningful for your assessment. And if there's a lockup period, that sounds like it.
Yeah, exactly. Great. Thank you.
All right, Heather.
Abe, really super interesting paper, really enjoyed it. And I guess I'm just going to pile on here with a high degree of skepticism that additional regulation here makes very much sense. Maybe that just means that you've presented it in such a way that it's so convincing that I'm kind of over it. But I guess one question is, like, especially the VCs, like these are repeat players, these are sophisticated players. And I guess I was just wondering, and you may not have insight into this information, is have you seen VCs asking for more disclosure, more governance features, the kinds of things that people are asking or suggesting as potential regulatory responses, especially after VCs kind of participate in, kind of invest in a company that ends up with a descending exit, descending IPO or insolvency. Do they change their behavior with their next unicorn? I mean, because if they're not, then I just, maybe it's different for employees, but if the VCs are not asking for additional kind of governance rights or disclosure or other information, I don't know why we would require them to get it.
Yeah, I mean, so no, I've never heard that. I do think there's some perception that maybe some of the late stage investors are in over their heads, or they're the dumb money, or I mean, traditionally that's what people said about corporate venture capital. Like when Intel goes around and tries to pretend to be a venture capital fund, that's not been, they're not like well regarded. I mean, that's actually one that is reasonably well regarded, but corporate venture capital has a sort of bad reputation. But no, I'm not aware of anyone really asking for anything different.
I'm not very sympathetic to dumb corporate kind of venture capital. And if they make mistakes and they repeatedly invest in kind of make bad investments and they can't learn, again, not sympathetic. So,
I mean, in theory, you could have concern about the mutual funds that make these investments then available to retail investors. And so that's
fair.
That's probably a little dicey, but then I don't know what it's Fidelity or it's T. Rowe Price. And I also have seen some analysis indicating that the amount of exposure to any one unicorn company is tiny in the types of funds that they put together and actually offer to retail investors. And so it's not as if we're talking about direct investment by sort of retail type investors.
Alina.
Abe, great project. I guess my comment is more of a comment than a question, but just to slightly push back, I agree, I'm not trying to say that there needs to be more regulation, but I'm not convinced that the only reason there doesn't need to be more regulation is because it's not going to better protect the investor or maybe even the employees. In other words, it's not so much about just the benefit of disclosure isn't just about who you're reporting to. It's the integrity of the company itself, right? So even if you still come out by saying, I'm not convinced by the disclosures or this quasi-public status that, unicorns need to have, I'm comfortable. That makes sense to me as a conclusion, but I think it'd be helpful to just recognize that there's internal company benefit to the process of having to go through reporting, even if there isn't some external party that's requiring it or that would really do much with it, right? Employees probably aren't going to use it. I completely agree. And I don't really feel bad for the investors per se. But it does seem like there could be something there for the company itself to better regulate and to share information across, the company that regulation could get at, even if you end up saying, but in the end, I'm not convicted by that. It seems like it would be a useful acknowledgement.
Yeah. Yes. I have to think about what the disclosure would be that would be useful. And I have to think about like who would then trying. Yeah. Go ahead.
And I'm not so much saying there's a particular disclosure they should do. I'm just saying the process of reporting and disclosure has a benefit to the company, even if, there isn't some outside party that's using it as accountability. In other words, it's the internal accountability. It's the process of, meeting with your lawyers on a regular basis. It's a process of maintaining good records. It's a process of making sure this is available to your board when they're, doing decisions. So all I'm trying to say is, there are other benefits of regulation than, just trying to, necessarily provide more information to other people. It's just the self-regulation and the internal good practices that regulation often brings. And even if you're not convicted by that, so I'm not saying that's enough to turn it. I'm just saying I think it would be a useful acknowledgement to include, which I think could honestly just be a footnote.
Well, and but more than, so you're making me think. I've focused a lot on sort of investor protection disclosure type, sort of new investor disclosure type considerations, but there's also like a governance aspect to this of like conflicts that emerge within the company and lead to bad oversight of corporate behavior and things of that nature. And I frankly haven't had that as much in mind as I wrote the last part of the paper. So to me, again, like I would want to think through like, what would I see that would make me concerned about that? Would I see more of the like WeWork, Uber governance breakdowns? If you saw more of those, you'd want to be a lot more trained on those type of sort of within the firm considerations. Interesting. Okay, thank you.
Great. So I'm just going to jump in with one last question before we close. It actually piggybacks on Alina's a little bit. I think she makes a great point about governance. And one of the things that was striking to me, and I'm wondering if you can sort of explain, is the finding that a lot of these ascending IPOs had a governance structure that's really out of favor right now, particularly among institutional investors. The kind of dual class voting, the strong founder model. And there was a real irony in that you had both that, and then you had some of these institutional investors coming in, and so you had both things. And so I don't know, just in light of what I'm reading in the corporate governance literature these days, that seemed like an odd combination for institutional investors to support that kind of governance structure in those ways. And so I'm wondering if you can speak to that.
I hadn't thought about it that way, but both of these last two comments have me thinking that what I think I want to do is think about what I would. So I focused on one potential marker for governance problems, and that was descending sales, because that's what Delaware courts are largely focused on, with sort of conflicts within the firm are these descending sales. But there's this other category of corporate governance problem, which is like essentially oversight type failures. And people are worried about that within this group of companies. And I haven't really thought about what types of outcomes I would expect to see that would make me more worried about that or less worried about that. And so I think that's the way I sort of need to think through it. And it may be that seeing lots of dual voting systems is one of the markers that should make me concerned about that. But I guess I have to think through it a little bit more.
Okay,
so.
great. Well, so we're at the end of our time. If people want to stick around and chat, if they're able, feel free. Otherwise, we'll see you next week. Thank you, Abe.
Yeah, thank you.